Ahead of that, it's up almost about 0.5%. And Maruti Suzuki, a couple of these auto stocks are also looking good. We had that CLSA note, which was constructive. On the downside, pharma stocks are under pressure. Cipla, Sun Pharma, Apollo Hospitals are your top 3 nifty losers, followed by Hero MotoCorp, SBI Life, BPCL. ITC is just taking a bit of a breather after hitting a record high yesterday. TCS is still sulking a tad bit. Titan is a little bit in the red, not too much. But largely, you'd have to say the market is just buying time around these levels. No directional call at the moment. But the advance decline ratio is well in favor of the advances. So that's a good thing. The bulls are trying their best to claw back. But let's see, not convincing just yet, but nevertheless a tad bit in the green.
Well, that's right. Stock-specific action continues though, Sonia. So quick heel, the numbers were very, very poor in a seasonally strong quarter, and the guidance as well going ahead is a little bit softish. So that stock, I think, is down close to around 8-9%, or quick heel should come up for you on the screen, down 8%. Just Dial, the numbers look quite good. The margins came in at the highest we've seen in the last 2 years or so, at around 14.5%. So that's up close to around 5.5%. Angel One, the Q4 EBITDA was up by close to around 20%. The margins expand by around 400 basis points as well. That's off to the races, up close to around 5.5% odd. Godavari Power and Ispat, the mining operations at one of their mines, I know mines, that in fact has resumed. So that stock in fact is up and about in today's trading session. A couple of other notable names on the downside. You have Tata Chemicals. Yesterday, the stock was down close to around 3% in the final hour of trade. It's followed up with another 2% cut because they have cut the light and dense soda ash prices by around 3 to around 4% odd. Fears of oversupply coming in there. Soda ash contributes around 15 to around 20%, as Sonal just told us, to the total EBITDA. So that stock as well is under a little bit pressure. A couple of stocks are reacting post large trades that we saw yesterday. So 361 WAM, that had opened up in the gain with close to around 1.5%, a pending large trade getting cleared out of the way. Z Entertainment as well, Oppenheimer sold close to around 5 crore shares odd at around 204 rupees. Yesterday, the stock was a little bit under pressure. Today, it's up close to around 1.5%. And Poonawalla Finance, the promoter entity, sold close to around 80 lakh shares in trade yesterday. It gained from the lows yesterday. Today as well, up close to around 0.5% odd. So a fairly decent start to trade after yesterday's pullback.
Yes, not bad. About 40 points higher. If you're looking for some more newsmakers, watch out for Jubilant Foodworks. Coca-Cola has put about 100 crores in one of their arms. That stock's up about 3%. Nestle is continuing its breakout from yesterday. Mitesh just mentioned that he's seeing fresh levels, fresh breakouts for both Britannia and Nestle on the charts. 1% up on that stock. There's some buying in HDFC Life. All in all, the market looks okay. About 40 points up on the Nifty, trying to stabilize. Banks are trying to add and build a little bit of momentum. 120 odd points up on the Bank Nifty. Mid-caps are also stable for the time being. So not a bad start at all, considering that the Asian picture was fairly muddled. So it is advantage bulls, at least for the time being. The market trying to get back to earlier levels of 17,800 plus. Well, it's a good time to then get our conversation going with the market master this morning. Saurabh Mukherjee, founder at Marcellus Investment Managers, is with us. Saurabh, good morning. Great to have you on the show as always. Been a long time, at least, that I've had a chance to chat with you. Tell us, the market seems to be at a very interesting juncture, and earnings season has started off in the reverse mode, right? Typically, it's IT that starts it off in style, and then you have the tail enders coming in. But as you look at the market right now, how are you feeling? Do you think earnings will live up to expectations? Because the rest of the picture, whether it's the dollar, US yields, US recession, there's a lot of confusing elements that are out there.
So, morning, Subhi. I think if you look at the two big profit generators that have reported so far, right, HDFC Bank and TCS, I think respectively the second and third largest profit generators in India. I thought those were really good results. So I taken both our portfolio stocks for us. So disclaimer here is I own them. My parents through our portfolios, through Marcellus's portfolios own them, and so do Marcellus's 10,000 clients. So HDFC Bank is 21% profit growth, 17% loan growth, and HDFC Bank has been doing this for 25, 26 years. Nothing new here. And even TCS, in what's supposed to be a US recession or close to a US recession, TCS is growing profits in mid-teens. Some of the strongest order book growth I've seen in many years, 25% operating margin. TCS's guidance is also very strong. So I thought these were sparkling results. And if you consider that this comes in the context of a world in which the relationship between the West and China is deteriorating by the week, and therefore the probability of heavy FII flows into India is growing by the week. And we've already seen some of that come through this one. I think this is a very nice situation. You've got big Indian companies like TCS, like HDFC Bank, reporting sparkling results. You've got FII flows coming in, the world tilting towards India, the domestic economy in good shape. So difficult to really imagine what more would a long-term investor expect or want from either big Indian companies or the Indian economy.
Saurabh, I mean, I take your point that you've been invested in TCS for a while, but I don't know how you can call these results sparkling, because in TCS's own admission, the sentiment has weakened in Feb and March. I mean, their constant currency growth was not even 1%. Their margins that they reported were under their own guidance, below 25%. So in what context are you calling it sparkling? I'm asking because at a time when the recession has not even kicked in, you're seeing numbers like this. So what happens towards the end of the year? This is Sonia.
Sorry, Sonia. The hallmark of all great Indian companies, right? All the great Indian compounders always downplay results. I've never seen, say, a Pidilite or a Titan or a Nestle or an HDFC Bank or a TCS hype up the future. I've never seen a single high-quality compounder hype up the future. So TCS is publishing results at a time when you've had about 4 large Western banks going under in the preceding 4 weeks. What would we expect them to say? It would be bonkers for them to say that the outlook is great. And why should you and I care about 2 months, 6 months, 1 year forward guidance from a company which has been around for 40 years, which has been listed for 20 years, compounding consistently cash flows and share price at 20% for 20 years? Why should you and I lose too much sleep about guidance, right? Look at the results. Look at the operating margins, look at the deal wins, look at the YOY growth in revenues and profits, consider the environment in which these people are operating. How these results are anything other than sparkling beats me. And why people look at guidance from companies which have been reporting for 80 quarters as listed entities, companies that are known to be conservative in how they think about the future. That's how great companies think. So in every which way, for anybody who's watching this, if you care about long-term investing, these are good results from proven companies. They're giving you a sensible picture of the world. They don't hype up their stock. They do the right thing for their shareholders. And in a difficult world, a world in which the China and the West is at loggerheads with each other, a world in which 4 Western banks have failed in the last 30 days, in a difficult world, these are outstanding results, I think.
Okay, all right. Hi, Saurav. Good morning. Nigel on this side. So we take your point then. For a long-term investor, TCS could be part of your portfolio now, given that we're likely to see some bit of softness. Got that. What about the pharma space? In the past, we've asked you about Divi's. I think the last time we chatted as well, you said it's a quality franchise. It's going to be looking up from here on. And you'd maintain that you all will add positions, at those levels. Now, from those lows, the stock has risen a little bit. And the export data that was reported was quite positive. Do you think Divi's will look up from here? From the peak, it seemed quite a large correction. So I ask you.
So November, December, we doubled our position. So I think going into Oct, I think it was 3% of consistent compounders. And then through Jan, Feb, we made it close to 8% of the portfolio. So it's a big holding for us. And again, similar position on Divi's, right? They too were listed around 20 years ago. So if you look at the 20-year track record, this is a company which from nothing has built itself into the 5th largest API manufacturer in the world. I would say amongst the large Indian pharma companies, by far the highest return on capital generator. You speak to any Divi's client. Divi's clients are the world's largest pharma companies. I would say 6 of the world's largest pharma companies, I reckon, account for around 80% of Divi's profits. You speak to them, as we do quite regularly, and they are giving us a very clear picture that America is turning away from China as a source of API. China makes 90% of the world's API. As America turns away from China as a source of the world's API, Divi's is a natural place for them to go to. What Divi's did on molnupiravir over COVID has won them many friends in the West. So for those who have short memories, in the space of 100 days, Divi's delivered for Merck molnupiravir, and Merck thus supplied the whole world with molnupiravir in 100 days flat, at a time when global supply chains were supposed to be in trouble, courtesy China, courtesy COVID. So impeccable track record of high quality delivery to the world's largest pharma companies, and therefore we unhesitatingly doubled the position through the winter months. The export data, whatever it is perked up now, but short-term data we don't lose too much sleep about. Focus on great companies with impeccable governance, capabilities, distinctive capabilities that their competitors don't have, and buy as much as you can when others are refusing to buy those stocks. That's something we've done for a long time. It served us in good stead. I think in Divi's lab as well, our expectations over the next 2 to 3 years, this company will get plenty of business from the Western pharma companies.
Let's talk about a sector that you've tracked for very long and companies that you've sort of looked at for several decades now, I guess, Saurabh. I'm talking about the consumer names. And if I'm looking at the right disclosure sheet, then Nestle, Page, Pidilite, all of them are still in your consistent compounders. What's the thought process here? Because again, there's been a debate about, how the lower end of the consumer market is getting impacted because of high inflation, high interest rates. It's all about the premium end, but that's not what FMCG represents. So how are you looking at it, considering we don't know, the monsoon is a joker in the room right now. We don't know if it sort of gets worse before it gets better. What are you expecting? I'm not talking about the long-term question, but in the near term, let's say this year, what are you expecting the consumer companies in your portfolio to do?
So look, I think I'll also add Amritanjan. So in our Little Champs portfolio, we also have Amritanjan. And as I think as almost everybody in India now knows, we used to own Relaxo. So if I split this into two parts, right, and this is, I think, a relatively established structural trend now over the last 6-7 years, and I reckon this will last for several years to come. The strata of society that, say, represent CNBC viewers is doing very well. Whether it's their investment portfolios, whether it's their cash flows in terms of earnings or their business profits, the strata of society represented by the viewers who are watching this program is doing very well in India. And any play around that, whether I look at our investment in Titan or Asian Paints or indeed Pidilite, any play around affluence, middle class, upper middle class affluence in India, we're seeing sparkling results. When we talk to the management teams, we're seeing enormous confidence about the years ahead. And we can also see heavy capex, right? So, for example, Asian Paints 5 months ago announced $1 billion of capex. Pidilite, I think, the best part of $1 billion of capex, and so on. So that part is relatively straightforward, and we stay heavily invested in all of these firms, Titan and Asian Paints, Pidilite, and so on. The part that is struggling, Surabhi, you're right to point out, is anything which caters to people earning, say, 2 lakhs per annum or less. And I would say around 300 out of India's workforce of 500 million, I would say 300 million earns 2 lakhs or less. That's the strata where there seems to be a real challenge with income going faster than inflation. Effectively, real wages are going down for these people. And that's why, in our Relaxo investment, the chappal piece took such a tonking. And say in our investment in Amritanjan, even in the pain relief space, we're barely seeing volume growth. So we are concerned about the fact that people earning 2 lakhs per annum or less in India, their incomes have stagnated over several years now. We're trying our best to figure out what the future holds for the strata of Indian society. But at the moment, I have to confess, the outlook does look grim for companies catering to the lower end of society. Thankfully, Nestle with its premium infant milk offerings and increasingly more premium offerings for pets, for babies. And Nestle has very nicely, very cleverly premiumized the portfolio. And hence we sit quite comfortable with our investment in Nestle. They've grown volume growth at 9-10%, but other FMCG companies have struggled to do that. I think Suresh Narayanan and team have done a spectacular job over the last 6 years in dealing with this shift in India, where the rich are getting richer and the poor are getting poorer. Nestle has repositioned the portfolio, I think, very smartly over the last 6 years to play the affluence of, just to keep it simple, to play the affluence of CNBC viewers, and therefore we stay happy investing in Nestle.
Okay, that's on the consumption piece, but I do want to come back to this discussion on IT. Saurabh, I take your point that, it's a hallmark of, excellence when a company comes out with a conservative guidance. I get that. But what do you do when a company comes out and tells you straight up that there are cancellations that are taking place? I'm not talking about TCS, but Infosys, right? I mean, not only was the commentary uninspiring, but the company said that forget about deferrals, there are also cancellations that they're seeing in certain sectors. Now, those are some alarm bells that you need to look at. So if you're a long-term investor, say in a stock like Infosys, what do you do at a time like this? Do you just take a step back? Do you churn out? Because that's clearly what we're seeing large FIs do at the moment.
So, Sonia, I'll tell you what we did this morning. In fact, just before I joined the call, I was discussing with my colleagues whether, Infosys looks tasty at the share price to me. because I don't see a problem here. This is a proven company. The great Nandan Nilekani is the chairman here. Salil Parekh's done a super job as a person running the company. I don't think the Western banking crisis is some sort of permanent state of affairs for the Western world. As we all know, it's been triggered by the Fed's rate hikes. I don't think the Fed's rate hikes are going to last ad infinitum. From what I know, only 30% of the Western companies have transitioned to cloud. So transition to cloud becomes a necessity for the other 70%. Technology is becoming more and more relevant for the whole world, including for the West. So given the scale of the opportunity in front of Infosys, given their track record, given their capabilities in helping Western companies transition to the cloud, I don't quite see what the dilemma is here. Yes, much like say Divi's Lab exiting COVID, if you have 4 banks blowing up in the Western world, you're bound to have some clients cancel your order book. If you're a large IT services company like Infosys, it'd be astonishing if some clients didn't cancel their orders. I mean, these are CEOs of Western companies. They're seeing banks will blow up in front of them. They'll cancel their orders. But should you and I get lost in that noise? I don't think we should. And this is where I think equity investors get a bad name when they sell Infosys on the back of the results earlier this week. I think sensible people out there should consider buying rather than selling Infosys at this delta. We don't have it in CCP, but as I was saying, the way it got tonked, it looks to me to be a great opportunity in a company which has proven itself over now the best part of 30 years of compounding and 30 years of becoming more and more relevant for the Western world, a Western world which needs Indian IT services companies now more than ever before.
All right, Saurav, just to clear the point, so you'll prefer TCS over Infosys as of now, but Infosys, it still looks like a very well-run company, and you'll are still studying it, right? So TCS over Infosys as of now.
Yeah, the smaller IT services companies we don't get so enthused about because they don't have the muscle. They don't have the muscle, the negotiating power, the recruitment power to deal with the scale requirements of large Western companies. But TCS and NP do. They're able to recruit successfully and cater to large Western companies.
All right. Well, differences of opinion make a market, right, Saurav? And we're taking note of your points as well. Saurav, final question before we let you go. You briefly mentioned that Amrutarjan is one stock that you all have entered and Relaxo is one that you all have got out. And when we chatted the last time as well, you pretty much had mentioned these two. Any fresh additions that you all have made, say, in the last couple of months or so, if you could share with us, or any stock that you all have exited as well?
Sure. So in our financials portfolio, Kings of Capital, we've added a company called Prudent Corporate. So these guys run a platform on which 25,000 IFAs work. So these are IFAs who cater to, say, middle-class people, lower middle-class people. The IFAs go and sell the mutual funds, life insurance, general insurance. Prudent Corporate provides the platform. So it's basically let's call it a wealth manager for the mass affluent in our country. And we like the financialization theme, and we think Prudent Corporate is an interesting way for our clients to benefit from the financialization of, say, CNBC versus wealth.
Okay, all right. In fact, I was just going through the stock. Last year, I think the stock was at, what, 500 rupees? And now it's had a fairly decent run, 811 right now. That's the one you're referring to, right?
That's right, yes.
Okay. All right. Saurav, we'll leave it at that. Great chatting with you. Thanks a lot. A very interesting and enlightening discussion. But we have to move on now and talk about the markets, which is very quiet at the moment. Not too much happening. The Nifty has given up on, that 17,750 level. It's just holding a little bit below that. It's a 20-30 point up move, and the Sensex is up 80 points. But what we have done is ended our fall from yesterday, which is a good thing. The Sensex still holding on to the 60,000 mark. Let's get an interesting discussion going now. A Prabhudas Leeladhar report indicates that seasonal products that we use, like air conditioners, fans, etc., the sales have been impacted because of unseasonal rains. Companies are also witnessing a slowdown in demand and high inventory. To discuss this, we are joined by Nilesh Gupta, the director at Vijay Sales, and Praveen Sahai, the research analyst at Prabhudas Leeladhar. So let me first get Praveen on board because he's the author of that report. Praveen, tell us a little bit about what you're observing because, with the heat wave kicking in so early, one would assume that sales of air conditioners, fans, etc. would sort of hit the roof earlier than expected. But what are your channel checks indicating?
Yeah, thank you, Sonia. If I talk of Q4, that's because of the muted demand environment and inability to pass on the increased cost. That has impacted the consumer durable sector as a whole in the Q4. And that's also because of unseasonal rain, soft demand, and also the higher inventory of the seasonal products like of RSC and the fans, which the companies has built up in the Q3. So Q4 impacted because of that. However, our channel check in the month of April indicates there is some, decrease in the inventory level in the channel, especially in the RSC. So just to give you numbers like of 40 to 50 days of inventory in month of Feb, which has reduced to around 25 to 30 days as per our channel check. And also the in the April, there is a change in the offer and the discount promotions which the brands are providing in the month of March because of some slackness in the demand, which has gone from the system. So that's also indicates some positive indicator for seasonal products like of RSC especially.
Okay. All right. Hi, Praveen. Thanks so much for giving us your view. Well, let's get in Nilesh Gupta as well. Nilesh, good morning. Thanks so much for joining in. What's your reading of the situation? Praveen suggests that inventory levels are lower, so I'm guessing demand is strong. Unseasonal rains, did they have some impact? Could you give us your sense?
So, good morning, everybody. So, this year we started on a very positive note because in the mid-February onwards only, in the month of February, from mid-February to end February, we had a good run of summer in the western part of the country and also slightly in the southern part, not so much in the southern part. So, what we expected was this year would be one hell of a summer sale, which we expected because it was onset of early summer. But what happened, everybody knows, in the month of March, the unseasonal rains came across the country and that dampened the sale to a large extent. And frankly speaking, till a week back, everybody thought that this time the summer season is a washout. But I do not know whether I should say luckily or not. But now, since the last 1 week, the summer has once again come with a big vengeance and we are seeing sales coming up. So yes, the month of February, the month of March, which we have lost, if the summer becomes more intense, we may be able to recover, or there may be a slightly lower sales than expected. But one thing is for sure, the inventory levels right now, nobody does corrections. For the simple reason is you have summer till the end of May in the entire country, and in the north, the summer still extends till June and July. In fact, sometimes it goes up to August also. So corrections of inventory, whether channel or whether in the brand, will not happen now. It will happen post 10th of May. Looking at the season, that is the time when retailers and distributors will start cutting down inventories if they feel the season is not going to go as it is. But looking at the last 1 week, I think we are sitting on a pretty good season now.
Yeah, got that point, Nilesh, and makes absolute sense that this is some western disturbance spells, I think, that have brought in the showers and brought some much needed relief actually in terms of the weather. But Nilesh, a word on average pricing. What trends are you seeing? By how much are prices higher over, let's say, the last season? And what's the customer response to it?
So basically, pricing wise, if you see over last season, we are nearly around 7 to 8% more. But nowadays, in fact, I've told this earlier also on your channel, pricing doesn't matter so much to the consumer because 80% of the sale is happening on EMI. So even when the price goes up, the corresponding effect on the consumer's wallet is not so much because the price gets, the payment gets divided into 18 to 24 months or 12 to 24 months. So price is not that big a worry for us right now. And one thing is for sure, now at least the prices are stabilized. So there's no worry of the prices going up again. So I think we are, it all now being a seasonal product, it all depends upon the intensity of the summer and nothing else.
Nilesh, is it still, you said 80% of the purchasing is happening on EMI. Are we still talking zero cost EMIs? Because otherwise, obviously, interest rates are higher. But is that the primary funding model, your zero interest EMI?
Yes, it's zero interest EMI, zero down payment also in some cases, and a long tenure. Earlier, the tenures of zero used to be only 8 months, but now we are extending up to 12 to 24 months also in certain categories.
Oh. Okay. Praveen, from the listed space and the stocks that you track, where do you see the maximum potential, both in terms of valuation headroom as well as growth here on?
Yeah, so in our coverage, we like a Havels over here because they are the one diversified throughout the different product basket, and in them the wire and cable from the last couple of quarters is doing well and expected to do well because of the real estate story as well as the B2B segment which are going to outperform, and in the Q4 also done very well. Secondly, on their ECD portfolio, it's largely on the fan segment, and with these regulatory norm change in the B side, they are going to get benefit out of that as well because of late in the last 3 years, they had excessively increased their distribution network under Ruder Vistar. So on that front also, we are expecting some improvement in the top line for them. Apart from that, the Lloyd, which has gained the market share for them, and definitely we understand that there is continuous losses with the Lloyd. But as for the management as well, that's these losses will slowly minimize, and we are also expecting the losses related to the Lloyd will minimize with the opening of their new manufacturing units in the south. So some logistical benefit they will receive. So overall, I believe that's out of all our coverage, Havels to outperform from here onwards.
Okay, all right. Praveen, I wanted to ask you about Blue Star. You know, we get the management and they have been telling us that they've been gaining market share. Now they're putting incremental capacity. Do you see a market share shift? Maybe Blue Star gains and Voltas loses out, or do you think someone else will lose out in terms of market share?
So you are rightly pointed out that's a Blue Star which has performed very well in terms of the market share over the last 2.5, 3 years. And with the opening of the commissioning of their manufacturing unit in the south, and their target also to improve their market share from 13.3% to 15%. So I also believe that the competitive intensity in the southern market is going to increase, especially for the Voltas, because not only the Blue Star, the Lloyd, Daikin, they are also coming up with their manufacturing units in the south, and we will see some logistical benefit for them, and that definitely will give a competition to the Voltas in terms of the market share. So definitely the Blue Star, the first mover to get the commission their manufacturing unit, and will see some market share shift as well for them.
Praveen, just before we wrap, my final question to you, what are you expecting in terms of margins for a lot of these durable companies? I mean, we'll also hear from them as we get through the earnings season. But in general, what are the trends like on margins, keeping commodity costs in mind?
So in the entire durable space, we will see some around 30 to 40% of improvement on sequential basis in the margin, whereas on the YO side, we still see some 70 to 80 bips of deterioration in the margin. Because the copper prices, which has gone back, and that's an increase. However, some of the segments like of a wire and cable, which are able to pass on the prices, they have taken already 3 to 4% of a price hike in the fourth quarter. So there would be no much of an impact, or even I can say they will benefit in the margin side. Whereas the other segments in the ECD side, with the elevation in the cost and the demand sentiment quite muted, we are expecting the overall sector to see some kind of a deterioration on the YOI side in the margin front.
Okay. All right, got that. Thank you very much, Nilesh and Praveen, for joining in and giving us your sense of the consumer durables market and, of course, how different companies are poised. The market, by the way, is getting very, very quiet. Now it's only a 8-9 point up move, so it's a little tough going for the bulls. Bank Nifty is doing quite okay, but there's a lot of drag from other biggies like Reliance, like HUL. There's more selling, by the way, on TCS, guys, so not that easy. ITC is lower. Now we're just 1 point up on the Nifty. This looks like a market that could it's slip and slide So yeah, not quite playing out as per script as the bulls would have at least hoped for.
Absolutely. But let's do one thing. Let's take a quick break on that note. By the way, lots happening at the Apple Store at the moment as well. So we'll try and cover that in greater detail too, all the action in case you're missing out on it. Sandeep Jain of Monte Carlo Fashions is also another guest that will be joining in just a while to talk about sales for the month of March. Later in our special segment, Charting Trends, Rahul Sharma of JM Financial will help us decode charts and technical trends in the market.
Welcome back. Well, as we were mentioning, the markets are pretty much flattened out. The Nifty now has moved into the red. However, what's encouraging is the kind of performance you're seeing from the broader markets. You have way more stocks that are advancing in comparison to the number of stocks that are declining. And the mid-cap index, it's up yet again. It's up close to around 0.4%. Let's pull up the small-cap index as well. I think that as well was holding in the green. Well, let's get to our next corporate then. We have Monte Carlo. They reported their best ever quarterly sales numbers for the month of March with a 36% growth compared to a year ago. The company's annual sales as well for the fiscal grew by close to around 22% in comparison to the previous year and a 51% growth in comparison to FY20, which was pre-COVID period. Mr. Sandeep Jain, the Executive Director at Monte Carlo, joins us on the show. Hi, Sandeep. Good morning. Thanks so much for joining in. Well, last year you told us you'll do something between 20 to 25% growth on the top line, and you managed that. For the coming year, that's for FY24, given that you've held a couple of trade shows as well, what kind of a growth number are you estimating for FY24? And now input cost, you have cotton, yarn costs that have cooled off a little bit. That'll be good for your business, right? So I think earlier you were talking about 20 to 22% margins. What's it likely to be?
Thank you, Nigel. So whenever we give our guidance, we have been very thoughtful and we want that we should be near to the accuracy. So normally we give our guidance once we have our trade shows are over, and that is expected to be over by 15th of May. So normally we give our annual guidance in the yearly results, which is around end of May. So at that time, we normally know about our forward-going business, about the bookings, about the home textile business. So that is the right time for us for estimating our current sales and the future sales also.
All right, Sandeep, but at least, we'll get the official guidance at that point of time. But now since the trade shows have been done and you have this, the home vertical business, that home textiles business that you all have been focusing on, could you tell us, as of now, the home textiles business, I think you were guiding for around 160 crores. What kind of a growth you're looking at, given that you've put in some capex out there? And can you do maybe high teens to 20% odd growth for the business on the whole? As of now, things can change.
See, home textile, we have a good news that the land has been procured in J&K, which is Kathua. So I think we'll start the groundwork now. So we hope that in the next year, Q1, we should have our plant operational. But in this year, we are again looking at home furnishing store, a reasonable growth. But again, as we have a trade show in 15th of May for home textiles, so at that time we can give the future guidance for home textile also. But I'm very confident that home textile is one segment which is basically growing faster than the rest of the business. And I hope that it should continue its growth.
Okay, so when you say continue its growth on an average, what are you looking at in the home textile business over the next couple of years?
I can't give you any forward statement as of now, as
Sure.
we have a trade show which is on 7th of May and 15th of May. So I'll let you know at that point.
All right. You've also hiked prices quite a bit. I understand that there was a 40 to 50% price hike that you took last year. Now, with input costs cooling down, would you be looking to roll back prices in the next couple of months?
The last year average price hike was around 10%. So this year the raw material price have gone down. So that will definitely benefit the brand, because normally the MRP doesn't go down. So margins should improve going forward.
By how much? I mean, do you want to give us at least a margin band that you could be looking forward to, given that input costs have cooled off and we are going to be spending more whenever we visit your stores?
See, we are hopeful to sustain our margins and improve our margins. Exact, I cannot let you know at that point of time, because macros are really challenging because of interest costs. It's pinching the pockets of the consumers. So that is one area which is some concern as far as going forward is concerned.
Earlier, Sandeep, we're looking for a couple of numbers. So earlier you were guiding, I think, for early 20s, right? 21, 22% odd. So you're saying the margins will be better than that at least.
I think that as the raw material has cooled down, I think that it should be near to that, some upward.
Okay, got it. So an upside risk to your margins is what we're looking at. Post your Q4 numbers, we'll quiz you a little bit more and try to get more concrete numbers. But on the home textiles business, I think it contributes mid-teens. Now you're saying that vertical will grow at a faster clip in comparison to your core business or your other part of your business. As a percentage of your sales, where do you see this number stabilizing? Clearly, you're indicating that home textiles is seeing good traction.
I think it was, 9 to 10% a few years back, and now it contributes almost, 14 to 15% of the revenues. And their contribution should also go up going forward in this year also, because we are seeing good demand from the home textile segment. And also, as our blanket plant would be operational by next financial year Q1, so that would add another growth. Should be around 60 to 70 CR in our top line in home blankets, home textile segment.
So the home textile business as a contribution will go up further, as you mentioned. But given that the demand environment is very challenging, do you think it will be hard to maintain that 30% growth rate in the home textile business? It's something you had guided for earlier. In FY24, you said that home textile revenue growth would be 30%. Now, do you think that could be a bit challenging given how the global demand situation is panning out?
See, one thing is actually what you're saying is right. Definitely, there have been challenges in the macro because of interest rates gone up and because of recession, and also consumers are spending less as compared to the past. But we are at a very small base. So higher growth is not a challenge for home textiles, as the base level is very small.
Okay. So post this expansion from around this 160 crores, home textiles, taking into account the J&K expansion, at peak, how much, what kind of revenues can it do?
I think if the J&K expansion is complete, we can easily go for 250 to 300 CR. 250
to 300 CR. All right. And you're hopeful that maybe at least by FY25 you can hit that mark in home textiles?
I hope so.
Okay. All right. I wanted to talk a little bit about the online channel as well. I think 6% of your sales, 6-7% comes from that part, the online channel. Do you see it grow further? Are you seeing a pickup in traction there or not too much?
I think, to be very honest, online sale has been growing in the line with the offline sales. It used to be grow at a very faster rate at pre-COVID times and COVID times. But now the growth rate is same. Last year, as I compared to this financial year, we grew the same rate in offline and online sales because the customers are going out and spending money. So that trend, which was like only online sales, will boost the sales. Actually, I'm not seeing visible this year.
All right, Sandeep, final question before we let you go. The stock price has seen a sharp correction actually. There was some euphoria that played out, I think, towards the end of last year. It was at 900 rupees. It's come down to 700 rupees. Any communication from some of your investors? I mean, is there some selling pressure or what's going on out there?
This is the only thing which I don't understand. Stock prices, plays on its own. So we are here for our performance, and then the rest of the market has to see the stock price.
I just thought we'll quiz you on that because it's a 25% correction, and going by what you're saying, your things are looking up for you. So, but thanks so much for joining in, Sandeep. and filling us in with your take on your business. By the way, the markets have taken a U-turn. You know, from being higher with a gain of around 70 points, 50, 60 points on, we're now down close to around 40 points. So that's a correction of close to around 80, 90 points from the high point of the day, Sonia.
Oh, absolutely. So, you know, yesterday's downtick that we saw, there's some more accelerated pressure. Then it's coming from Reliance, Tech Mahindra, TCS, L&T. A lot of the heavyweights continue to contribute on the downside. So, good time to get Rahul Sharma. He's the Director and Head Technical at JM Financial Services to give us his view. Rahul, thanks for joining in. You know, this market had such a smooth trajectory, but now, you know, brakes have been put on the rally, so to speak. Do you think there is a reason for the uptrend to resume itself? What are the levels that you're looking at in the near term?
Yeah, good morning, Sonia. So we've enjoyed a streak of green candles, you know, day to day, back to back. We've seen a phenomenal 1,000-point rally from where we were in March end. Now, obviously, a bit of pullback here would be healthy for the technical trend. Yesterday was the first session where we actually formed a lower low, and finally, you know, Nifty is seeing some sort of a pullback. Now, this pullback basically means that, you know, it's only making the structure more robust, because the quality of this up move has been far, far better than what we've seen in the past. So just to give a perspective, the market breadth and thrust indicators are clearly above what they were the last time Nifty was at an all-time high. So this indicates that, you know, the participation has been broad-based, and the length and breadth, both of them have been quite good in terms of the entire 1,000-point rally that we've seen. So what that translates into is a very good buy on dip market, where key support levels are to be, you know, kept an eye on. And like, for example, 17,500 as we speak is a good support level going into the next few trading sessions. 17,500 is also the 38% Fibonacci retracement of this entire rally that we've seen from March end onwards. And the move has got long legs. I would, you know, be looking at a figure of 18,200 in the April series itself, which is a significant upside given the kind of setup we've had. Now, clearly there are multiple reasons. One reason being in Q1 calendar year this year, we have been the second worst performing index globally. So even if we play catch up with the global markets, which have been doing very well, we are easily above 18,000, 18,200. Secondly, the relative comparison of Nifty 500, which is the broader market index, with the S&P 500, the US broad market index, is suggesting that the period of underperformance with respect to US equities is done, and probably from here we should start outperforming them. On the way down, we fall less, and on the way up, we participate more. So these are the two key factors where we feel that, you know, this move has got long legs, and we should be heading for the 18,200 mark anytime soon.
All right. Okay. So we'll outperform. So that's good news, Rahul. Good morning. Thanks so much for joining in. Rahul, what about the PSU banking index? Are you tracking that? You know, many of those PSU stocks, they did very, very well. Then they went in for a bit of a correction. But do you think now they're good for more?
Yeah, Nigel. So, you know, first we saw the Nifty 500 index breaking out from the downward sloping channel. Then it was the Bank Nifty, then Nifty. And finally, yesterday, what has happened is the PSU Bank index has broken out from this entire correction that we have been since last 4 months. Now, clearly, you know, the quality of move has been very good. The volume participation that has been in PSU banks is worth noting over here. So what is happening is the volumes have gone through the roof across stocks, and this has been not only the top tier PSU banks, but the entire kitty of the PSU, where even the smaller names, the lower or the tier 2, tier 3 PSU banks have done well. I think from an index perspective, a 10% up move is very much possible on the PSU bank index. From a stock perspective, this move can be even higher. Around 15% is where we are pegging at in this particular up move. So I think PSU Bank Index is the latest one to add on to this string of breakouts that we've seen in the last few trading sessions. And I think, you know, it just adds on to, you know, more upside for the Nifty as well.
All right. Any individual stocks that, you know, you like where the trend is on the upside? All right, those are the visuals of the new listing. Avalon Technologies Limited going to list in just a while from now. Okay, let's wait for that and let's see how it looks. Remember, it's about an 865 crore, you know, IPO. Not done really well in the opening tick. Just a bit subdued. I mean, the case is similar with the market. So the market sentiment is not that great today. Subdued listing over there. The company is an integrated electronic manufacturing company, so it focuses on a lot of high-value, precision-engineered products. It has about 12 manufacturing facilities across the globe as well. It gets a large amount of its contribution from the clean energy and the mobility space. So it is into, manufacturing of electronic components for segments like clean energy, for mobility, for the industrial segment, for the communication vertical. That's the space it is in. Post this issue, the promoter holding will go down to about 51% in the company, and they will be using the money. It's a fresh issue of 320 crores, out of which part of that money will be used to reduce debt. So they have about 145 crores of debt reduction that they've planned through this IPO. But Rahul, sorry, we just had to take a little bit of a breather because of this listing. I was asking you about any other stocks that you see an uptrend in from the Nifty, in banking or in technology.
Yeah, while this has been a broad-based move, I think three key sectors where I think the focus should be is one is banks, second is NBFCs, and third is capital goods. So, starting with capital goods first, because this is where the best risk reward is, there as we speak. Larsen & Toubro is one stock which has taken a beating since last two trading sessions, and primarily this has been because of what has happened in the IT space. Larsen holds a significant chunk in the IT space as well. So I think 2200 risk reward is very much favorable for L&T. Capital goods as a sector has got long legs. I think 2400 is where we are looking at. So for 10% upside, one can look to get into Larsen & Toubro. From the banks, I think it has to be, the smaller run PSU banks. Union Bank is one setup which we like a lot. Easily around 10 to 15% up move can be expected from these levels. The risk reward again is very, very, attractive at these levels. And from the NBFC space, Poonawalla FinCorp is one stock that we like particularly. Yesterday, there was a big volume expansion seen along with a reversal on the monthly as well as weekly charts. I think, there is a good 10% upside to be had in Poonawalla FinCorp as well. So these are the three ideas, L&T, Poonawalla FinCorp, and on the banking pack, we like Union Bank of India.
Okay, got it. Thanks a lot for joining in, Rahul. Appreciate your thoughts. Let's slip into a quick break on that note. But on the other side, we have the management of Just Dial joining in. Abhishek Bansal will be joining in to talk about their Q4 earnings. Stay tuned.